Structure your accounts. Do you know how to structure your accounts for retirement? Knowing how to structure your accounts is important, especially if you're a part of the FIRE movement. Do you know about the FIRE movement? If you haven't heard of this, we also have a video on that too that you can check out. FIRE stands for Financial Independence Retire Early. So what are the three main accounts? You have your after-tax accounts, a normal taxable brokerage account, and a tax-deferred account. These are all your retirement accounts. Structuring your accounts is important in your path to becoming financially independent and eventually retiring early. We will be going over all these types of accounts today. They may sound complex and intimidating, especially for those who are just beginning to work and hoping to retire early. But don't worry, we got you, because I'll not only go over these accounts, I'll also be telling you how you can structure these. Let's dive into it, shall we? Welcome to Savvy, where we have lots of practical wisdom to share. Hey, don't forget to hit the like button below, subscribe, and hit the notification bell for more advice here on Savvy. Today, I'll be sharing with you how to structure your accounts. Let's talk about a tax-deferred account first. When you put money in and you get a tax deduction, that's what a tax-deferred account is. If you withdraw the money, then you're going to have to pay ordinary income tax rates. But let me tell you about a tax-free bucket. Sounds good, doesn't it? Well, to be fair, anything tax-free sounds good. When talking about asset allocation, this is how your money is spread among large capital international cash bonds. Although it seems as if tax diversification on accounts isn't talked about enough. Let's get into after-tax and taxable brokerage accounts. These two accounts are taxed differently, hence they're different accounts. The money that you hold in these accounts should vary depending on how much they are taxed. The money you hold in these accounts should be different. This is for you to look at your taxable income investment accounts and see where you can have a more favorable capital gain for long-term holdings. Instead of ordinary income, you can also pay a capital gain rate. You should have qualified dividends that are more favorable to you. So the assets that you're putting into these taxable accounts should not be ordinary income producing assets. For after-tax assets, you can access your cash before reaching the age of 59, which you know you can't do with IRAs and 401ks. If you access these before you are 59, then you'll have to pay a 10% penalty in addition to your after-tax assets. When you reach the age of 59, you can start having access to more of your assets and resources. Money is a liquid asset that is the easiest to access. Everyone would want to take advantage of capital gains and dividends for lower tax rates. If you want to live off of all these resources, then you have to be sure that you don't have just one portfolio. You're going to have to set aside money and put it in any of the accounts, so you do not pay more taxes. How do you manage an after-tax account? Through time, you can manage your tax after account. What do I mean by time or in time? Let me give an example for those who need more understanding. Last year during 2021, in the fourth quarter, the market was down. S&P was down by 20% at that time. If you feel that it's best to change investment allocations, then you can reduce risk. The biggest account said the millionaires have is their work for 401k. These are referring to pre-tax deferred accounts. These accounts have great potential for earning more in the long run. Getting used to saving every month and investing, regardless of whether the market is up or down, and usually as volatile as it is. and you would be surprised at how much you're able to earn as long as you trust the process first. Do you have a Roth asset? What else can you suggest for those who are part of the FIRE movement? Share it with us in the comments below. Now let's talk about what a Roth asset is. You can build a Roth asset in a 401k retirement plan. It isn't always the best choice to make. It's either you make Roth contributions or you pre-tax it. This all depends on your federal tax rate and state tax rate. Add the two values, and if it's over 30%, then it's best you do pre-tax, because this should be a better choice for you. If you're between 25 to 30, then you can try doing a splitting strategy, since you'll have to consider the account timing of retirement age and the structured tax code of whatever state you're in. Let's move on to tax-free. If you're part of the FIRE movement, then ideally, you'll be retiring early, so you won't be a part of the workforce anymore by the age of 70. It's important to remember that at 59M, you gain access to IRAs and 401ks. By 70 and a half, you'll be required to take minimum distributions, which is where you'll have to pay taxes on all the benefits. Before the government requires you to pay these taxes, there may be a way for you to control these. This depends on the money you have for your after-tax and tax-free. You can make Roth conversions to lower the taxes you have to pay. Your Roth account can be like a piggy bank, where you can get money if you need emergency funds, since it's easy to access. That, or you cannot touch any of your Roth assets, especially if you're trying to build a nest egg and you want to make sure that you can live off of your investments during your retirement period. If you want to be able to withdraw at a safe withdrawal rate, then you can leave your Roth asset alone and just let your assets continue growing. The accumulation and compounding growth of your investments are what will help your money grow. Retiring early is something a lot of people want, if not everyone. Retiring early gives you the financial freedom of not having to rely on your job to make a living, put food on the table, to have a roof over your head. Retiring early is a goal that everyone should have. You don't need to work for 40 or 50 years for you to experience financial independence. That's enough practical wisdom for today. Don't forget to give us a thumbs up below. We will be posting 4 to 5 videos per week, so click the subscribe button and the notification bell to be notified of our new videos weekly. Thanks for tuning in. See you in the next video.